Hey, and welcome back to another video here at Fiscal Voyage. I'm Felix, and in this video we're going to talk about the 5 best Canadian banks that you could buy today. But first, before we get to the 5 bank, I have a 50-page ebook that I want to give to you guys for free and it's called The 5 Steps on Finding the Best Dividend Growth Stocks. In order to get the ebook, you must subscribe to the channel and like the video. If you're already subscribed to the channel, just like the video and then send a screenshot of the subscribe and like to my email, which is info@fiscalvoyage.com. The email address is also in the description. So again, it's a screenshot of the subscribe and liking of this video and send it to my email address, info@fiscalvoyage.com. It's a 50-page ebook on the 5 steps to finding the best dividend growth stocks. So the 5 banks is the first one, Canadian Imperial Bank of Commerce. The second one is the Bank of Nova Scotia. The third, Bank of Montreal. The fourth, the Toronto Dominion Bank. The fifth, Royal Bank of Canada. So we're going to talk about those 5 banks, Canadian banks, and find out which one is actually the best to buy right now. So let's get started. We have here the 5 banks. There's CM for the Canadian Imperial Bank of Commerce, BNS, Bank of Nova Scotia, BMO, the Bank of Montreal, TD, the Toronto Dominion Bank, and RY as Royal Bank of Canada. So the 10-year revenue compounded annually, the best one is TD at an 8.49% rate compared to CM, Canadian Imperial, at 4.86. For the 5-year average, the best one was CM. So CM has been growing it in the past 5 years relatively higher than the other 4, but still more or less in pace with the other 4. Net income, TD won that one at a 10.78% increase for the past 10 years. And for the past 5 years as well, TD won that one. As you can see here, BNS and CM are in the lower range for net income for the past 5 years. So that's a little concerning as they're not growing their income as much. So that their expenses are much higher. However, credit rating, both TD and Royal Bank are AA minus, which is not the best credit rating, but it's much better than the A plus credit rating. So AA minus is much better than these 3 here. So that's a great credit rating score. And earnings for the past 10 years, Royal Bank is the winner here at 7.42%. However, TD won it for the past 5 years. They've grown earnings at a double-digit rate. For 2019, fiscal year 2019, the company had, obviously different earnings. As you can see here, net margin, TD won that one slightly versus Bank of Nova Scotia, 27%, where TD won it at 28%. So TD has a better net margin percentage here. And return on equity, for the most part, the double digit, and the winner here is CM. Of course, the higher the return on equity, the better. And the same thing with net margin, the higher the net margin, the better. It's more profit for you. Debt to cap, the winner here is BMO. We're only 6% debt to cap, but none of these are alarming. As you can see here, TD has a AA minus credit rating, so there's no concern here with this 17% debt to cap. The best dividend yield at today's prices is CM with a 7.03%. However, all these dividend yields are very high in the sense of the S&P 500 normal 2 to 3% dividend yield. So you get almost double or triple the dividend yield compared to the S&P 500. And the 5-year dividend yield average, as you can see here, is much lower than what it is now. So that's definitely a good thing here. The dividend payout ratio, you can see here, Royal Bank of Canada is the winner here, 58%. But again, all this payout ratio is because earnings are expected to be lower this year. So even if earnings is lower, these are still somewhat safe payout ratios. So it's highly unlikely that these companies will cut the dividends based on these estimates of earnings for 2020 fiscal year. And they all have nice consecutive years of dividend growth. They all froze their dividends during the 2008-2009 financial crisis, which is great considering most American banks like Wells Fargo, Bank of America, Citibank, things like that, they all cut their dividends during that time period, 2008-2009, where the Canadian banks held it. They froze it. It was still paying out. They weren't increasing it, but they were able to start increasing around 2010, 2011. So that's a very plus. So this is a good indicator for me that if worst case, they won't cut it, but they'll freeze it and just continue paying out quarterly dividends, but which is a good thing. The 5-year dividend growth rate, TD won this one at 9.64%, where most of them was averaging 6%, 5%, 7%. Charter rule, TD also won at 15, which is the 5-year growth rate plus the current dividend yield. So 15 here. You like to see it over 11 or 12, and we got all of them over 11 and 12, where Royal Bank is at 12.31. The most recent dividend increase, most of them was sometime last year, and TD did the best at a 6.8% increase, which is great because a lot of these, this 1.4 is less than inflation. This is kind of a little higher than inflation. This might be right at inflation. Same thing with Royal. So I like to see companies with a growth rate of at least 4% and higher, preferably higher, so that your income grows much higher than inflation. Analysts expect 2021 earnings to be much lower than 2019, as you can see here. For example, last year CM had $9.04, and expect $6.71. BNS at $5.37 last year. This year $3.92. So earnings are going to be lower for all these companies. But the good thing is 2021 analysts expect much higher earnings. It won't be as high as 2019, but it's heading in the right direction, higher. CFRA has a 3-year projected earning growth of 1% for CM, Bank of Nova Scotia 6%, which is the winner here, and 5% for TD, 4% for Royal Bank. My dividend drill return model projection, CM had a projection return of 12.20%, but even then, the other 4 banks, you can see here, is still respectable return rate. So I'll be happy with any of these return rate. Current PE is low versus their 5-year PE average. So 7.6 for CM versus the 5-year average of 10. BMO has a 7.8 versus the 5-year average of 12. And TD has a 9.7 PE versus a 12.7 PE. And we look at price to book here. The best one is Bank of Montreal, 0.89. So you're getting it less than the book value, which is great. So you always want to see that down. However, all 5 of these are much lower than their 5-year average, which is a good indicator that they're undervalued. All right, so let's look at the Canadian Imperial Bank. As you can see the fast graph here. Again, the black line is the monthly closing price, the orange is the earnings with a multiple of 15, and the blue is the normal multiple of 11.2. As you can see here, the company tends to follow the normal multiple of 11. But let's lower this to 10 years. This is here more consistent. The company will return to its normal multiple. You see some undervaluation here at 9, and now we're getting at 7.63. So this is a good indication that the company is undervalued. Go back to the multiple of 10, based on these 10 years. You can see here that the projected return could be quite nice at 36.8. All right, so let's look at Bank of Nova Scotia. You can see here it's the same thing as CM. The price likes to follow the normal multiple. Here at the 20-year period is 12. If we go to 10 years, it's 11.6. And you can see here there's some in some part of the years they were overvaluation, and then returned to the 11 multiple, some undervaluation here at 9, then return back. So if that stays consistent, here we have an 8 PE multiple, and if it goes back to the 11 based on 2021 expected earnings of $4.58, you have a nice total return of possible 55%. So that's very attractive here as well. So now let's go look at BMO, Bank of Montreal. Same thing. It follows the blue line, which is a normal multiple of 11 for the past 20 years. If we lower the time period for 10 years, same thing. It likes to follow the normal multiple of 11. So that's a safe bet that the company likes that range, 11 PE, based on earnings. So if we look here, it revert back to the 11 PE. It went over it at 12 here, and then went back down. So it likes to follow that. So again, if it follows it, you have a total return potential of 52% if it hits the earnings of 2021. Again, this all works if analyst was 100% correct. If by 2021 the company earns $8.26, then the fair price would be $92. Now, if this drops to $7 or whatnot, then the earning multiple of 11 would drop as well. But there's a good indicator that it's undervalued if it meets this estimate. Now let's go to TD. Same thing here. The company likes to follow the blue line. You can see here, if we go to the 10-year period, has a normal PE of 12. So if it goes back to that 12 PE, you have a nice 31% return projected. So again, it affects the earnings estimate. So this estimate needs to be right on for this to actually come to fruition. But if it doesn't, even if it's 550, you're still looking at a nice increase. It might not get to, it won't be 31%. Maybe it gives you an annual return of 15%, 10%, but you're still making money. Now let's go look at Royal Bank. So same thing here. As you can see, all the 5 Canadian banks like to follow the normal multiple of around 11 and 12 historically. So we now have a multiple of 10.2. So again, you could have potential 31%. So all these companies have a potential total return of 30% to 40% for the next year or two. So it's very attractive at these prices. If we look at the prices here, CFRA, these are all the fair value prices from CFRA. Morningstars, here you go. Fast graph as well, as we saw. And the fair price, as you can see here, CM is undervalued by 30%, BNS at 36.4%, BMO 37%, TD 33, RY 19. All of these are buy at current prices. However, I own actually CM, BNS, and TD out of the 5. I don't plan on buying more shares of these companies because I'm happy with my current positions. But if I was to buy one right now out of the 5, I would go with TD because of, as you can see here, it has more of the greens. It has a better credit rating. The 5-year earnings growth is much better. Net margin is much better. The charter rule is better. The dividend increases has been better as well. So compared to the other 4. So that's why if I was going to invest in any of these 5, it would be TD at current prices. All right, so that was the 5 best Canadian banks today. Make sure to like and subscribe to the channel. And if you do like to subscribe to the channel, don't forget to send a screenshot of that and to my email address, info@fiscalvoyage.com. And I'll send you my free ebook of 5 steps in finding the best dividend growth stocks. So thanks again for watching. See you in the next video.